when there's a PAL speech, when there's FOMC, I like to trade early in the day because the price action tends to be a little bit more obvious in terms of what it wants to reach for. It's far less likely to be like a seek and destroy or a high resistance liquidity profile because there's a lot of professionals in the market trying to get in and take something early on and let everyone else gamble after or during or ahead of a PAL speech. Typically, the days that have the Fed chair speaking, whenever they would speak, leading up to that, the market would tend to be a little bit more fickle, a little bit more challenging. And in my opinion, they were better left to the novice traders, someone that just wants to believe they can gamble and get lucky. On days that your Fed chair is speaking, and it's in the afternoon, or if it's really early, like say it's like a 10 o'clock, or even a 9:30 or 9:15 or 9:45 speech. Anything, okay, prior to 9 o'clock, in my opinion, is pre-market because the opening range is 9:30 to 10 o'clock. If there's a Fed chairman testimony where they're talking, any time within that 9 o'clock to 10 o'clock hour, you want to be trading before 8 o'clock in the morning. Today, if you look at the economic calendar, you'll notice that there is one medium impact news event. That's the Chicago PMI number at 9:45. So that's 15 minutes after the opening bell. So that's fine. That'll help fuel some of the first 30 minutes trading. My counsel to my son is because it's a 9:45 medium impact news driver, he has to sit still and wait until 10 o'clock. He'll let that news driver come into the marketplace, let traders either get canceled out, stopped out, or get kicked into an idea based on what they see at the 9:45 news event. Okay, so that's like the minimum criteria for anything that comes after a high impact or a medium impact news driver. Wait 15 minutes. The pre-market session is anything before 9 o'clock in the morning. We have a Fed chairman testimony today, but it's in the afternoon. So you can trade all the way up until the opening bell. 7 o'clock in the morning starts it. Sitting down at the charts, this is what I do. Okay, this is exactly what I do on Sunday. So I deferred everything that I would normally do then. I'm doing it now. This gap up here, the volume imbalance here, I want to give the market the opportunity to explore lower prices. And what would that look like? Well, we already have what would be the start of a potential turning point. So I would like to see if we can make an attempt to start breaking down. And now I'm going to look at what I want to try to see in price action, formulate some kind of a game plan. I like the idea of entertaining the likelihood of trading down into this gap here this week. So basically what I'm doing, I'm giving you a breakdown of what I do on the weekend. Sometimes I'll do it on a Friday, and then I'll have notes about what I expect to see based on a higher opening on Sunday's gap or a lower opening gap or a lack of a gap. We're up here, we traded to a premium relative to the weekly chart last week, and then now we're in this week's present candlestick. The inefficiency on the weekly chart is this candle right here. This week's high, that week's low. This individual candlestick only has buy side delivery, and it would be reasonable to anticipate the market wanting to go and explore this low. Obviously, if it makes the effort to get down into this inefficiency, this one here, September 9th. So the week of September 23rd and September 9th, effectively shown here. And this is the weekly high for that week. Now you can go as far as going into adding the consequent encroachment of that. This wick here, you can annotate that with consequent encroachment as well. And this one, and then the daily chart. We have this little gap in here of volume imbalance here and a volume imbalance there. Whenever there's consecutive volume imbalances with just one single candle like that, just do the entire range. It makes it very easy. You'll see the inefficiencies just the same as you would if you just done them individually. And since it's a premium array, you want to have some kind of a hue. Usually you only see something like this candle's body to that candlestick body, and that's a volume imbalance. But there's one immediately to the left of that too. So just to encompass the entire range there. It's fine because this is actually an indecisive candle. All right, so now you should already notice that there is two lows down here that are real close to one another, right? When we drop down to, I'm going to skip entirely over a 4-hour chart because it's not necessary. If I was swing trading or if I was trading for like the entirety of the weekly range, I would drop down to the 4-hour and do this same type of thing, looking for specific PD arrays. But because I'm not trying to swing trade, I'm not trying to do anything except for session trade, or at the very least, I'm trying to do just a session trade or scalp, but up to the daily range. And that can be afforded to you by simply looking at the hourly chart. So we're going to do a 60-minute chart now. You see this big wick right here? This is a level. I go through the charts and I write down all the things that I'm doing right here. Any wicks that are at lows or highs or in close proximity to market price, I annotate those consequent encroachment levels. And if it's something that's a discount, like this would be here relative to where we're at here, this is where the market price is right now. This wick is lower than current market price. So that means that this is a discount. Whereas something like like this wick would be a premium wick because it's above current market price. This is another level here. This will be annotated as an hourly, and it's because it's lower. I put a little tiny D next to it, so it tells me it's a discount. I go through the daily chart. I like the idea that we cleared this high here. I like the idea that we went into this inefficiency here. This is sell side imbalance, buy side efficiency. I love the fact that we traded back up to change the state of delivery, which is my order block theory, and it's the opening price of the up close candle right here. So that is a really nice delivery there. That opening price there and this high, that being together, that's nice. I want to see price try to go lower this morning. My bias is bearish. I want to see something that I can frame as a narrative now to go lower. Well, we already noticed on the daily chart there was some relative equal lows that I spotted, but can we see them on the lower time frames where it makes sense? So we can drop down from the hourly chart now to a 15-minute time frame. It's the obvious things that you're looking for. If it's not obvious, you're probably straining to make it work. So we'll drop down to an hourly chart to a 15-minute time frame. And here's the business from here's Friday and then Sunday. Looking at the lows here, notice how that low has that lower low to the right of it. And then this low has that low lower than the one here. And this low has the lower low here to the right of it. And now this low has been breached by this. So we don't see any kind of relative equal lows here. The market keep probing lower. Remember what we have later in the afternoon, that Fed Chair Powell speaking. We have a little bit of likely volatility coming in. And then what we'll have is some kind of a Judas swing, right? Between 9:45 and 10 o'clock in the morning. All I'm doing is just using one chart, the NASDAQ, keeping your focus on one instrument. You have to start this way. And I wanted a little bit more confidence by having something behind the scenes giving me a little bit more courage because I was lacking a lot of that in the 90s. By looking at currency futures, I was using the Deutschmark, comparing their highs against the British pound, against the highs of the Japanese yen, against the highs of any other currency, Canadian dollar, Australian dollar. And I would go through and I would find the one that was failing to make a higher high. I would use SMT on a 15-minute time frame because it's my bellwether chart. So just notice the lay of the land here. We have slightly lower high here, higher high here, consecutive little higher highs in here, and then I would refer to ES. You can see the high is higher here now. On the NASDAQ, we didn't have that, so that's SMT. So NASDAQ at that time, since then, it's been weaker. Just remember these reference points here. This high is lower than this one, and now look at this. See this high here? This one's lower on ES than it is for what? NASDAQ. So S&P has an S&T divergence. This high doesn't make the same high that we see in NASDAQ. And watch when I toggle back. See? So that's why you're getting that X-ray view behind the scenes. But you would already know being short in this inefficiency is appropriate because you have this lower high than this one relative to what we just saw on ES. So on my notepad, I just simply note the time that at 8 p.m. Sunday, that there was an S&T divergence, 15-minute time frame, at 8 o'clock between NASDAQ and ES, and NASDAQ is the weaker. So I just put an NQ and a negative next to it. And you don't need the S&T divergence here to tell you to get into a trade because you can see that that inefficiency there is what you'd be entering. You don't need to have any kind of S&T divergence to tell you that trade's good because it's already there. What makes it good? Sell side, buy side, both taken. When we had a divergence back here, showing you that the NASDAQ was weak. We have a built-in heaviness. And this just so happened to be a little bit more aggressive just to get in here to offer a nice premium. What makes this a premium? Why is this wick right here, why is it a premium? Because if you look at the range from this candle's high down to this candle's low right there, and we draw it out here, is that wick above the middle center line? That black line right there. That wick right here, that wick right there, that wick right there. Either of them could be short entries because you're in a premium, because you're inside this inefficiency between this candle 1, candle 2, candle 3. The inefficiency is always candle number 2. Your stop is always above candlestick number 2. But if there's small ranges like you're seeing here, you can use the candlestick number 3's body. If it has a wick, you can use consequent encroachment of that wick. That's what these dashed lines are. So it's a new week opening gap. And now on the 15-minute time frame, okay, I'm going to zoom out and take in more information. So we have daily relative equal lows, and look what is below it. We have the weekly buy side imbalance, sell side inefficiency, but it just so happens to be inside of the same proximity of this low and that low. Okay, so you have sell side liquidity below these relative equal lows. All right, so we have a SIBI here, sell side imbalance, buy side inefficiency, and we're also inside of another inefficiency that's being shown. And we have the 60-minute discount wick consequent encroachment. That means on an hourly chart, that big long wick that went lower, that made a swing low at, that's half of that wick. So in my mind, before we drop down to a lower 5-minute chart now, in my mind, I'm anticipating a run to this level. It might want to go down below it, come back up, dilly-dally around that consequent encroachment level, worst case scenario, and then dive into the sell side, resting around that 19,953 level. Now let's go down to a lower time frame. All right, so we're looking at a 5-minute chart with the new week opening gap. That's what that purple dash lines are. The only concern I have is that these highs, even though there was SMT between ES and the NASDAQ, recall that this high here on ES was slightly higher than that of the respective high here. But looking at this chart, if I'm wrong, I do believe that we're going to get down here, like based on what we have right now. What changes that? What makes me put that idea on the sidelines for a little while until something gets back in favor of it? I have to have a contingency plan. This is what I'm looking for, but if given the opportunity to find a short trade, this is what I'm aiming for the purpose of trading to engage the liquidity or reprice to inefficiencies. That's the only things that happen algorithmically. If it's not being delivered that way, then manual intervention comes in, and then you see what we saw like last week, or FMC, or like when Powell starts talking today. That's absolutely 100% manual intervention. That's why you should not be doing anything while he's talking. And for 15 minutes after he stops talking, start looking in price and looking at my PD arrays. And when they start booking perfectly to the tick, that means everything went back to algorithmic delivery. Because it's Monday, I'm not on payroll, and we have Fed chair talking this afternoon, we want to be able to find our setup within the first hour of trading. So that means 9:30 to 10:30. If you can't find your setup then, don't do anything. Because the closer we get to Fed chair talking later on in the afternoon, the closer we get to the afternoon lunch hour, the more likely that you're going to get slapped around. So you have to have a limit in terms of the time that you're willing to do something on the day that the Fed chairman is going to be talking. Wait 15 minutes after they're done talking, and then go in and see what we have. If the prices are reacting to my PD arrays and inefficiencies are trading into them and then leaving right away, you can tell that we're back to algorithmic delivery. If it's not like that yet, don't trade. You have to be much more rigid about when you don't do something. In a 5-minute chart, we have our inefficiency here. We're going to drop down into a 1-minute chart. What I'm watching here is see how the bodies are just hanging around the middle of this inefficiency. 9:30, so we have a discount gap that could trade up into here. Right, so we're in the lower quadrant of that opening range gap. I was saying earlier, if I was wrong about it going down into the weekly imbalance and that hourly discount wick, it may want to come up and take buy side out. So it could take a pass through. This is assuming I'm wrong. It could trade above that and really entice people to think it's going to go higher. And then I'd have to wait for it to break down again and then get down below whatever first fair value gap that forms in the 1-minute chart. But any setup, the entry would have to be in the first hour trading, so between 9:30 and 10:30. And if there's no entry, there's no trade. Buy side has been ran here. So we went above the opening range gap. Any of this run here, I'm not interested in any of that. If it keeps on going higher, it simply means it's going to do it without me. Low shaded area to that high shaded area, it could come up here and hit that. If it's going to go there, it would make sense for it to wick above, get the liquidity out here. Otherwise, it would need to stop with the bodies in the upper quadrant of it, right about where it's at, and then roll over. All right, you can see what ES can do, right? There's your buy side. So it might be trying to get up here to disrupt this. So for ES, monitor this one, because it does definitely have a draw on liquidity there. Good Dow. So what we're seeing here is the decoupling. Decoupling is when all three averages are doing something different. This drop down is not seen in NASDAQ. It's not seen in ES. Let's go back to ES. See that? So I would expect them to come up here and disrupt this. They don't have to, but it would be much more meaningful if they hit it and then started to sell off. That means they took out these individuals here. If they take them out, what are they doing it for? They're taking them out to take their stops, and they're going to sell short against those buy stops. Anyone that's short, they have their protected buy stop right above here. So it's reasonable to anticipate the market want to go up there. What would be the narrative for that? Well, if it goes higher on a day, it goes without saying that would be a nice area for them to take partial profits and lock in something profitably. But I like the idea of it going there to see if it can unseat these individuals. They don't get to have the profit here. It's being taken from them. And then if it sells off from there and it starts to build in technicals that would send us down to that sell side, that's the idea, and that's the side of the market I want to be on. The only element of Dow theory that I do use is I like the idea, if I'm bearish, I want to see all three averages moving in the same direction. I don't see that here today, neither do you. The Dow has dropped. The NASDAQ has gone higher. So this is a decoupled, whenever you're trading, looking for a setup, or when you're in a trade setup, you want to see all three averages agree. That means if you're bearish and you're in a short, even though I don't like the Dow, but it is usually sometimes the canary in the coal mine, where if we see the Dow just saying, no, I'm not doing something that you other two are doing, that may be indicative of something changing. Not all the time, but if I do see a divergence between the NASDAQ and the S&P and they're not doing the same thing, that's clearly a time when you don't want to be trading, because you're in a decoupled condition and you're most likely playing in a sandbox where manual intervention is about to happen. So long story short, you want to have a day or a session when you're trading where all three averages are green. So we took out the highs. We ran over here and took the high out over here. I told you if it was going to go to the high of that shaded area, it'd be reasonable to anticipate them blowing out the stops above here, which we've just seen them do that. So I would want to see it. Unfortunately, it's probably going to have to hang around up here until ES completes its rotation for buy side. It would be highly unlikely for it to leave it like that and just start to drop. It's happened before. We saw that a couple weeks ago with the NASDAQ. It just left those quadruple highs up there and dropped like almost 1,000 handles and then came back for it later on. Now watch with the Dow. Are they all agreeing? No. So how can you feel comfortable sitting on the sidelines and that you don't have a trade on right now when the market looks like this? All three, in a perfect world, when there is symmetry, this is not a symmetrical market. A symmetrical market is where all three averages are moving in the same direction. This is saying, I'm not even going up there. I'm going to go lower. Which to me, I'm taking that based on what I've already did as in the pre-market analysis, that this is the canary in the coal mine. It's saying that there's something wrong with this. Let's go back and look at the other indices. Here's the S&P and here is the NASDAQ. So I would like to see NASDAQ just stay here, hold it like a bull flag formation, let everybody anticipate it breaking higher, and then a sharp breakdown lower. And then inside the opening range gap, treat the midpoint, once it gets below that, treat that midpoint as a premium and then sell off from there and displace. But we have the very first fair value gap here on the 1 minute chart is at 931. It's rather large. And this is all ahead of the Chicago PMI too, by the way. That comes out in less than 4 minutes. So I take this as them fluffing up the market, stopping out any individuals that were short, and then they may elect to take the market down sharply into our objectives here on the day or going into tomorrow. That's kind of like what I internalize. I see it. Look at the Dow. This is garbage. Look at that. It stopped dead on the high. That would annoy me, to be honest with you. If they just dropped it from there, that would absolutely annoy me. But it would mean that we're probably going to have to come up there later on, which would be fine, right? If they're going to take it all the way down to our NASDAQ objective, they're leaving what up here then? Buy side. So coming all the way down to that deep discount on NASDAQ and dropping ES in sympathy with it, this would be where the market would draw to on the upside if it goes down there. Looks like we're trying to build in that pseudo bull flag thing. We really should be looking at ES, Michael. See if they want to run those relative equal highs. No matter what price is doing in this environment, because there's a decoupling between all three averages, that gives me a confidence to sit still. If every average was moving in the same direction, I would feel like they were probably going to take it higher and continuously move higher. But because the Dow, it looks like it was the canary in the coal mine this morning saying that it went down when the other two averages, the NASDAQ and the ES, went up. ES has unfinished business here in the form of buy side. That's the holdup for anything going short for me. I want to see it go here, disrupt these relative equal highs, and then see how we trade after it does that. And I would like to see it move lower sharply after it goes there. So I'm sitting here, I'm waiting for certain criteria to be met to frame the idea around the narrative I already outlined this morning. We have a few clues that might be in play, but we still have to work through the effects of the Chicago PMI. High impact or medium impact news drivers, they use these as smoke screens. The market's not reacting off of the number. The market's going to go to where it needs to go. In this case, it's going to go to where the stops are. But knowing where the liquidity is, the time of day, how this entity cannibalizes other traders that don't realize that it exists. Let's take a quick look at that real quick. Still ugly. Okay, see what it's doing? It's just hanging around. I like that. To me, I view this as it's got to look like it's trying to be bullish to allow ES to do its damage on those relative equal highs. That's how I see this. This right here, it's ugly. It's really, really ugly. That's exactly what I was telling you. So it's going to hang around in like this bull flag type formation where people are going to want to see it go higher. They want this to break out to the upside. Retail traders want to buy this. They want to be long in this, especially after seeing all this shit. So by having ES with its unfinished business up here, but we're waiting for the green light after the buy side's taken here. Now, let me ask you a question. If you were, say you went long, okay, say you were long in here, somewhere in this area, or maybe you used this inefficiency here, how would you feel with the way the market is trading right here? Would you feel uncomfortable? Would you feel like you're comfortably going to submit to it eventually break into the upside to get these relative equal highs? And would you expect that to continue if it goes up here and keep moving higher? Or are you trying to just get out and be done with it here? Because admittedly, I would be a little uncomfortable with the amount of time it's spending in here, because it could very well do what we saw a couple weeks ago. The same thing with NASDAQ. And it would fit the underlying idea about if it's going to drop for NASDAQ to go down to that weekly inefficiency by them leaving this area up here smooth like that, because it doesn't have to go up there and do that. I just want it to do that. And then that would give me confidence if it starts to break down. Then we can take our attention over here for sell side for ES, and then what we were looking for NASDAQ, down here. While it's up here, retail traders are not thinking anything down here. It's completely outside their radar. They're not even thinking about it. They don't think it's even possible. They're looking for a continuation to the upside. A small little gap here. Now, you've learned again something new today. I've taught this already. It's in core mentorship, but I taught decoupling in the core content lessons. And the same thing with Forex. If you're bullish on pound dollar, you should see in a symmetrical market, euro dollar be bullish and dollar be bearish. In Forex, you want to have a correlated pair, positively correlated, meaning euro dollar is positively correlated to euro dollar. They usually move in sympathy with one another. Dollar sitting still, pound dollar going up, euro dollar going down. Yeah, that's going to be a euro pound short. If the dollar index is consolidating, that means that your crosses without the dollar in them, closely correlated pairs, that will make them go up and the dollar will just sit still. So, in reality, Forex is a lot more complicated. So where it's at right now, that volume imbalance, that should be the end of it. If it's going to go up there, it should be done here and it should start to move up. If not, it's going to break below here, and then we'll start seeing the NASDAQ move in sympathy with that of the Dow. Look at the Dow. It's just staying down on its lows. So whenever you see this decoupling, every price run, whether you're trading the ES or if you're trading the NASDAQ, so they should be moving in agreement. All three should be going up if they're bullish, and all three should be moving down when they're bearish. If there is ever a time when that is not true, like we see here this morning, that is a sit still and wait. And we overshot that volume imbalance by a little bit into a gap here. Like I said, and when it gets down to that volume imbalance, that should have been it. We should have started to rotate higher. If it's going to go up for that buy side, that was the time for it to do so. So far, it's indicating that it could. I'm more interested in once we get there, once we get into this area here, does it hold? Does it stay there and go higher, or does it go there, spend a little bit of time, which is reasonable, and then start to break down? Because that means that they went out there to accumulate those buy stops, and now they've unseated anyone that was profitably short, and any movement lower, they're on board with the targets and things I've outlined at the beginning of the pre-market analysis. So far, there's literally nothing in here that I would be long on. I'm watching the bodies in here in respect to this gap. Look at that gap I was telling you there. And then let's take a look at the Dow real quick. Pulling up into its gap right there. It's a little smooth, I guess, on the upside, isn't it? They might want to pop that with ES. This is a complex market to trade in this morning because you have each indice doing its own thing, and it's real hard to frame low risk in that environment. You can see what it's likely to do, but is it worth putting your money behind it? So we're inside the new week opening gap here. It's also consequent encroachment of the opening range gap. In a perfect world, it would want to drive into this sell side here. This gap as it was trading up into that. I was telling you, watch that gap right there. Very close to the high, that imbalance. It's shaded in purple, whatever shade that closest to purple is here. Now in that yellow box, what can happen, and I would like to see happen, is for it to drop down, stay inside this red box, come back up and touch the bottom of the yellow box. And if it leaves that volume imbalance, come back up and reprice to that volume imbalance between this candle's here and here. Hit that and then rotate lower. But it may not do that. It may just take off rolling. Either way, it's fine. I told you I wanted to see it go to here, but I'd like to see it use the opening range gap low that this yellow box represents. I don't want to see it deliver like that, though. It needs to be a separate candle. In other words, if the candle would have been down here and stopped and created a new candle and trade up to it, any type of return back to a premium array, you want to see it do that. You don't want to look at it on the same candlestick where it moves away from the PD array and comes back to it and say that's never what you want to see. That's never, ever, ever a point of entry for you to use it like that. It needs to create a new candlestick and trade up into it. Then expect it to roll over. This is what you get by just reaching into these little lows here, back inside the opening range. So let's take a quick look at ES once more. This is the benefit of having multiple screens, by the way, or dividing your screen. But I want to keep one big chart on the screen as I talk. So imagine you're an ES trader. How are you feeling right now? You feel confident? Are you confident about your short? Are you confident about your long? Are you confident that you made the right decision by sitting still? Are you regretting that you did anything yet? Or did you chop yourself up already? Because the market didn't chop you up. You chopped yourself up. And how do we anticipate decoupling? Whenever there's a Fed chair speech, FOMC, those types of things cause decoupling. Everything just unravels. And that's why you have to wait 15 minutes after he's done talking to allow for things to try to get back in sync. And they may not get in sync in the first 15 minutes after he's done talking, but you wait until they do. If you don't see that, you sit on your hands and you don't feel bad about it. I mean, look at the ES. Oh, that would make me mad. If I was in that, man, I'd be like, man, come on, what are you doing to me? And NASDAQ is rolling back down outside of the opening range gap. So same thing I was outlining here. I'd like to see it trade down in the lower portion of that pink box, create a new candle without leaving or going below this low here. Create a new candlestick, come up and trade up into the low and or the lower quadrant of this yellow box. Because we went back up and did what? Traded back into the new week opening gap, repriced to the volume imbalance right in here between these two candles bodies and here. So the only market that's doing what we would want to see happen in price action is the NASDAQ. So the symmetry in the market as a whole is broken, but we are able to see price cleaner on this one than we can see it on the Dow and or the ES. It's just as good coming up. Didn't quite get to it. So by it not trading back to the opening range gap low, breaking down like this for the sell side, that's actually weak. That's good. You want to see that. See if we can rush down below these lows and accelerate, not just go below it and come back up into the opening range gap. We don't want to see that. Now again, I don't want to see it just go below these relative equal lows. I don't want to see it go down there a little bit and then come right back up into this yellow box. That's not something I want to see. Beautiful. Looks like a thumb. There's that gap still in play. Let's see if they want to jump up there and get that little area there. Somewhat of a breaker. All right, so NASDAQ should get some movement lower. So we're leaving those three highs up there in ES. So that bolsters the idea of if NASDAQ can get down to where we were outlining this morning, they might be onboarding longs there and then come up higher later on. Not necessarily today, but later on in the week it might be revisited. Key takeaway, Caleb, so far is we were able to see that gap right there could be used, and we've been framing the idea that we want to see NASDAQ go down. So we've seen the market trade lower. We had a swing low in here that was pierced there. So you have a shift in market structure. Fair value gap trades up into it beautifully, but then we delivered nicely off of that. And then we traded down to half of the first presented fair value gap, which is this candlestick here. If I'm bearish, and this is the fair value gap that we're going to focus on, how would this candlestick be used? As an inversion fair value gap. When you're bearish on the market, up close candles that make a fair value gap, which is a buy side imbalance, sell side inefficiency, is going to be a bearish inversion fair value gap. If we go down, like we do here, we went to consequent encroachment of that gap. We've been bearish. The market used the fair value gap I outlined before it went into it, trades lower, trades down into and away from, see the orange shaded area here, this box? We left it, came back up, went right to consequent encroachment to the tick. Then it behaves as an inversion fair value gap, lower. If at any time after it delivers on the basis like it's done here, it's reacted and left it and took out a low, that is already done enough to afford it as a properly classified inversion fair value gap. It does not need to trade down the sell side here. It does not need to go down to the target I outlined today. It offered a trade to take out the sell side that would be resting right below that low here. From consequent encroachment to that low, that's a setup. If we ever trade back above and back into this fair value gap and come back down into it, this would be classified as a reclaimed bullish fair value gap because it's an up close candle. That's how you classify it. So again, even in a sloppy, disjointed, decoupled market where the ES is doing this and the Dow doing that, our market, we did pre-market analysis on, and all the PD arrays are delivered. Fair value gap, I told you we were going to consolidate around up in here. Perfect. I told you retail's going to want it to go higher. Well, what am I doing? I'm arm wrestling retail with smart money concepts. Smart money traders are shorting up here, accumulating those positions. Then we have a displacement lower at the fair value gap. We were down here. I told you, watch this fair value gap here. Trades up into it perfectly, drops down. First fair value gap here. A buy side imbalance, sell side efficiency. When we're bearish, meaning what? It's going to be used as an inversion fair value gap. Once it trades out of it, comes back up. Consequent encroachment. You want to see the lower half be used for entries, and once we leave it, the upper half stay untouched, and that's exactly what you're seeing here. And then our market's traded down into sell side liquidity there. So now we take this and we couple it and we dim this one. Okay, so we want to see this expand down We don't want to see it come back up into this inefficiency up here. It's in this box shaded area. Opening range gap, take that out for now. You can see the inversion fair value gap there. And we want to see speed here aggressively run down and take that sell side. We don't want to see them be able to pull their orders. If you were long from anywhere in here, or you went long up here, but your stop loss is below here, how confident would you be that you're in a good position to still be in the trade, or that you think this is still a bullish market? These are all questions that I think about when I'm watching price when it starts to move towards an old low or an old high. I try to put myself in a position of who was in this trade right now, who was getting long or maybe would have regretted being long, and maybe they might look this and say, hey, this is a good time to buy now. I missed this opportunity, but now they're presenting this. So is that something that they would be wanting to buy into that? Yes, every single time it moves. We're almost in that fair value gap. This one's so dirty, it's probably going to want to unsettle these highs up here. That's more like where I would expect them to take the Dow, because Dow just broke lower rate from the opening. What are characteristics of high resistance liquidity run profiles? Deeper retracements than you want to see. Targets get traded to later than you want to see them traded to. Smaller inefficiency there. 3 up close candles. Change in state of deliveries, that opening price there. That would be like the last line in the sand for me. I wouldn't want to have anything else go higher than that. Like I said, I don't want to see them come back to that first presented fair value gap. To do that is problematic for being short in the first hour trading. In quick summary, I'll try to do this in 1 minute. We looked at how the market presented reasons why I believe that we still could be down here. I think that will still be a factor for this week. They left this sell side in place. They went back inside of the new week opening gap, which are these 2 purple dashed lines in here. And we're back inside of the first presented fair value gap. Caleb, you would not use this as your short. Here, yes. There again, no. What is it doing? It's returning back to your point of interest. If it's going back there twice, it's not as good as you want it to be. And you want it to react the first time you get into it and then displace lower. It did go to our sell side. It got close to the next one here, but then said, no, I'm not going there, and started pulling back up. And I told you, I did not want to see it return back to the first presented fair value gap. I didn't want to see it go back to the low of this imbalance here. So because it was going to go here, it's going to go back to the first presented fair value gap, and or inside what? New week opening gap. So if it's going back there, that's fine. It's going to do so without you. So your trade would be entering here at consequent encroachment of your first presented fair value gap. That's going to be inversion. Also keying up on the new week opening gap, laying over top of that. And your target would be these relative equal lows. You take a large portion off. Why? Because you're in a decoupled market. And then your next target would be here, which did not pan out. So you'd be stopped out going back into the first presented fair value gap. So you're only going to be able to annotate with the basis of this being your profit taken. You watched as much as this deliver, but that next level didn't give it to you. And it went back to what you heard Dad say. I don't want to see it come back and touch this inefficiencies low here or the first presented fair value gap. To do that doesn't afford you enough time to trade in that first 1 hour trading. So you have to stick to the rules. Even if this does roll over, you have to have rules, son. You have to have a basis to stick within and say, this is the guidelines I'm staying inside of. There are days when I don't have to trade, and it could still move around with a rhyme and reason that I can still see. That doesn't mean I need to go in there and risk real money. And then when you don't have these types of conditions, because there really isn't anything else now. There is no other reason to stay out of the marketplace. We've already covered all 3 bases. High resistance liquidity profiles. They're tradable, but you have to handle them differently with a wider stop and hold on to that stop near your entry. Seek and destroy, you can't trade it. And then decoupled markets. You can trade them, but you're probably not going to get your targets. You're going to have similar things like a high resistance liquidity run profile, where it's a lot of give and take, but it'll eventually get to where you want it to go. But are you going to be good enough to pick the NASDAQ over the ES? I don't think you will. So to keep that from ever being an issue, I told you to stay with just the NASDAQ.